Welcome back to yet another episode of E.M.I. That's Economy, Markets and Investment. This is the E.M.I. for the month of December. In this month's E.M.I., as usual, we ask a few questions. Here are the main questions. Do the recent years of FDI flows hint at a probable change in India's external dynamic? Can India's FDI repatriation and outward FDI flows can they be linked to equity market movements? Are India's FDI flows and outflows coming from very similar countries? And lastly, could India's FDI flows be transforming into a more liquid subtype? So let's jump right in. Is India's FDI flow undergoing a structural change? This is the key question that we're trying to address. India's FDI inflows and outflows appear to have seen a lot of change in flow behavior, and this has drawn a lot of attention to a probable change in India's external dynamic. We touched upon net FDI as a topic in our India macro lens in December 2025, and we stressed on why it was a key piece to India's currency financing puzzle. The next logical question then to ask is what has changed around India's FDI? While gross FDI flows continue to rise post the pandemic, India has seen a sharp increase in repatriations and outward FDI. From just above 40% of gross FDI inflows in FY20, repatriations and outward FDI accounted for 99% of gross FDI inflows in FY25, consistently reducing India's net FDI flows. Now remember, net FDI flow is equal to gross FDI flow minus outward FDI minus repatriations. As a refresher from our India macro lens from December 2025, also remember that repatriations are largely foreign investors plowing back their profits from India to invest in other markets. And outward FDI refers to Indian companies, their acquisitions and investments abroad. Now, why does all this matter? Mainly because FDI alongside FII has been a key component of India's capital account flows, stabilizing the volatility in other category heads. FDI inflows accounted for 52% of India's capital account flows in FY20, and this shrunk to just 6% in FY25, leaving the financing of India's current account deficit to other category heads. In short, the sharp rise in India's repatriations and outward FDI has worked towards weakening India's capital account flows and, as a result, current account deficit financing. Let us now dig further and get to FDI's three key components. Of the gross FDI flows India receives, around 56% is in the form of equity that also includes equity of unincorporated bodies, equity through RBI's approval route, acquisition of shares by companies, etc. Reinvested earnings by existing FDI in India accounted for the next 32%, and other capital amount to the last 12%. Both FDI into India and FDI by India, also known as outward FDI, are seen to be broadly directionally linked to equity market movements. Now, how so? Now, we drill down further into two variables, repatriations and outward FDI, searching for plausible explanations. Now, the results came as a pleasant surprise to us. India FDI repatriations seem to directionally tag Nifty 50 returns on a consistent basis post the pandemic. In other words, as India's equity markets trended higher, repatriations seem to witness an increase and vice versa, implying profit booking behavior. India's outward FDI, on the other hand, was seen directionally tagging the returns of US's S&P 500, implying US's outperformance as a probable pull factor. This co-movement of FDI flows and equity markets make it tempting for one to link FDI flows to that of stock markets. However, it probably isn't as simple as that. One must remember that large scale projects are initiated predominantly using equity payments, and FDI positions or mergers and acquisition valuations are recorded at market value, partly explaining this co movement we mentioned. However, this then means that post the pandemic, FDI flow movement appears to suggest a certain financialization of FDI flows, or maybe a more liquid FDI perhaps. Before getting into more details, let's break this flow a bit and get into the countries where India receives FDI from and countries to which India's outward FDI goes. Examining the set of countries from which India receives FDI and to which India's outward FDI goes, we land up with seven key countries with 80% of the flows: Singapore, Mauritius, US, Netherlands, UAE, UK, and Switzerland. These seven countries account for 79% of FDI inflows and 77% of outward FDI flows. Singapore and Mauritius are seen as two key countries among both FDI inflows and outflows, mainly due to them being low tax jurisdictions or tax havens used to channelize investment. Our September E.M.I suggested that 30% of FDI inflows from Mauritius and Singapore were probably attributed to the US. One could probably extend a similar ratio for outward FDI. Now, breaking gross FDI flows into sectors, we see them concentrated in manufacturing, financial services, electricity, other energy, and communication services. Outward FDI flows, on the other hand, witness concentration in financial, banking, insurance services, manufacturing, wholesale retail trade, restaurants, and hotels. Let's now get back to the liquid FDI concept that we spoke about earlier. India's FDI flows appear to have changed to a more liquid subtype. In April 2025, the RBI governor, in a keynote address in Washington, D.C., opined that higher repatriation and outward FDI were, quote, a sign of a mature market where foreign investors can enter and exit smoothly, unquote. Now, this appears to give some credence to this concept of a liquid FDI subtype that could probably be more financialized and responsive to market movements. This is important because for a while, FDI inflows were largely assumed to possess a certain implicit irreversibility and as a result were seen as a stabilizing factor. One probable explanation for the rise in repatriations could be the surge in IPOs and primary market issuances, giving investors large exit opportunities. If FDI flows are to be seen differently, perhaps in a liquid way, this could have very different policy implications and structural takeaways for rupee management. Though categorized as FDI, reinvested earnings are just technical FDI, recycled money already present. Excluding this from the calculations further thins out FDI and the stability it brings to India's capital account. Currency stability apart, one must remember that for a capital starved country like India, attracting new equity financed projects are of great importance. And unlike developed markets, emerging markets like India do not possess a high degree of substitutability between types of flows, resulting in more likely phases of volatility in monies flowing into India. Till next time, this is Arjun signing off.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.